Okay, let us continue about accounting for partnership. As I mentioned, there are some differences on how we handle the capital accounts compared to the sole proprietorship. Sole proprietorship, we only have one capital accounts because we only have one owner. But for partnership, the amount of capital contributed by each partner might vary. So we need to see what are the balance. We need to reconcile any changes in the balance of capital account for each partner. So we have several methods. Method number one is the capital account that include profit and losses. During our EK 111, when we do our sole proprietorship, we only have one capital account equity, and we're going to change the amount of equity based on the profit for the year as well as the drawing. So we apply the same method here for our partnership. We have a capital account that include profit and losses. So only one account capital. If the partners, the business make profit, so the partners' capital will increase. If the partners withdraw money, the partners' capital will decrease. So it continues. So we only have one account, capital account. So drawing is debited to record the withdrawal of asset and payment of personal expense by individual partner from the partnership asset. For example, let me just draw a simple example. So this is capital for A, for example. This is the capital is 100,000. This is the balance. And then this year, A should share profit of 10,000. Okay, this is share of profit, yeah? Share of profit 10,000. So A capital now is 110,000. But during the year, A withdraw maybe 5,000. This is drawing. So A capital, now the balance for A capital, Mr. A capital is 105,000. So we need to account any increase in the profit, share of profit of A, and B has drawing, and also minus the drawing. Maybe we have another example. Maybe I just create another example. Maybe capital for Mr. B. Mr. B, originally he also contribute 100,000. So the share of profit is 10,000. So the total is 110,000. But he doesn't have any drawing. No drawing for B. Drawing is 0. So the balance now for his capital is 110,000. Are you okay with this? So we need to maintain the capital accounts for A and B. Any increase in the profit, yeah, share of profit will increase the capital, and any drawing will reduce the capital. So that is method number one. So drawing account for each partner is typically close to his or her capital account. So drawing account will close at the end of the year. So if we still remember when we do closing the accounts process, number one, we're going to close the revenue accounts. Number two, we're going to close the expense account. Number three, we're going to close the income summary or P&L summary account. Number four, we are going to close the drawing account, transfer the drawing account to the capital account. So this method applies in the method number one. However, for the method number two, this is what I call as the fixed capital accounts. What I mean by fixed capital accounts? The amount of capital will not change. The amount of capital will not change. We have a fixed capital accounts. We're going to have another account we call it as current accounts. So the capital account for each partner is credited when assets are invested in the partnership by the person. So when we have a drawing account is debited on the withdrawal of assets and the payment of personal expense by the partner out his or her share of profit or expected profit. But the drawing account for each partner is close to the retained profit. We have another account, retained profit account for each partner. We have the capital, then we have the current or the retained profit account. So we have two accounts instead of one. So the capital interest of each partner is to receive should be agreed on and specified in the partnership agreement. The agreement is made entry to record the formation of partnership can be made. How the process, what are the things involved in the formation of partnership? The fair value is the price that will be received to sell an asset or transfer liability in orderly transaction between the market participant at the measurement date after deducting all the costs of that transfer. So this is, for example, when B, we have two partners here, Becker and Cook. Partners number B and C. This is the assets. When they create the partnership, Becker has a balance in cash 60,000 at bank 60,000. Okay, this is the cash amount. Cook has 20,000. So when we do the valuation, the cash always has the same value 60,000, 20,000. Account receivable also the same, but for inventory it might be different because inventory is subject to the rule of the lowest of cost and net realizable value. So in Becker account, the value of inventory is 43,000. When you look at the fair value of that inventory, you realize that the inventory value is only 40,000. So we're going to use the fair value of the inventory. Whereas for Cook, even though his record is says value of inventory is 9,000, when we create the partnership based on our assessment, the value of that inventory is 10,000. So we're going to record using the 10,000. Same goes to the equipment. We're going to record the equipment at the fair value. If you notice from this example, we have equipment 80,000. The accumulated depreciation is 35,000, so it should be 45,000. But when we form the partnership, based on our valuation, the value is 50,000. So we're not going to use this 45,000. We're going to use this 50,000 value. Yeah, 50,000 value. Okay. For the another equipment here, 42,000 and 18,000. 42 minus 18, this gives you 24,000. But based on the fair value, the value is 20,000. So we are going to use the fair value of assets in recording the formation of the partnership. So what will be the journal entry? It's very easy. Assume that the partner agree to have capital balance equal to the fair value of net asset contributed and the ST is not applicable. So the journal entry will be like this. We're going to record for Becker first. For Becker, his contribution is cash 60,000, inventory 40,000, equipment 50,000. So the total capital contributed by Mr. Becker is 150,000. Whereas for the second partner, fair value is what is fair value? Okay, there's a question. There's a good question. What is fair value? What is the carrying amount? Carrying amount is amount recorded in your book. This is your book amount. Your book amount. Yeah. For assets, this is the cost. This is the accumulated depreciation. So the net will be the carrying amount. Amount recorded in your book of accounts. What is the fair value? The fair value is the closest market price available for that asset. What is the value of that asset if you dispose that asset or you're going to replace that asset in the future? So what will be the cost of same level, same type of asset in the active market, yeah, the active market. So that is the fair value. So cash 20,000, account receivable, inventory, equipment, land, building, and we also have liability here 40,000. So the amount contributed by Cook is 100,000. So the capital for Cook is 100,000. Capital contributed by Becker is 150,000. So this is how we should create the journal entries for the formation of partners. Yeah, debit assets, credit liability, and the different is the plug-in number will be the capital of partners A, partner B, partner C. So allocation of partnership profit and loss, the partners should consider the three distinct elements that make up partnership profit. Number one is a return for the personal service performed by the partners. Personal service performed by the partners. We have five partners, two of the partners working or running the business. So they should be paid on that. Yeah. Number two is a return on capital provided by the partners. We have different type of partners, different amount of capital contributed. So the more you contribute, it should be the higher your return. That's criteria number two. Maybe we have one rule for number one and another one rule for another number two. A return for the business risk assumed by the partners. So for the business risk, what are the return assumed by the partners? So it can be fixed ratio. Fixed ratio mean it is the simplest profit and loan agreement is for each partner to allocate profit and loss based on specific ratio. For example, equally. For example, equally. What does it mean equally? If you have five partners, maybe you already fix it 20%, 20%, 20%, 20%, and 20%. So we have equals. We have equals, yeah, equal or fixed. Maybe you have this fixed percentage, A get 40%, B get 30%, and this get 20%, and this is 1%, 1%. So we have fixed rate, yeah. Okay, the method may be appropriate if partners' contribution can be stated in terms of fixed percentage. Yeah, fixed percentage. I contributed 40%, so I should entitle or 40%. We agree that based on that formula. So in this example, the business has a profit of 60,000, make a profit of 60,000. So we are going to close our P&L summary and then going to put in another accounts we call as P&L or profit or loss distribution 60,000. Okay, we have 60,000. How are we going to give this 60,000 to three type of partners? Two type of partners. We have two type of partners. Backer, another one is Coke. So how are we going to give them? For example, if you use based on share of profit, we can give 50-50. Yes, we can give 50-50. If we give 50-50, then we get 30,000 and C, Cook will get 30,000. That is equal rate. Equal mean everybody going to get the same amount of money. So this is the simplest way. But sometimes it's not fair. It's not fair. Why I say it's not fair? Why? Why it's not fair? Because there are situations, and mostly it happen that one partner contribute more, right? For example, capital backer maybe contribute a lot of money, maybe contribute 30,000 or 50,000 or 100,000, whereas Cook only contribute half of it. So that is the issue. So in that case, they come up with certain formula there, maybe ratios, yeah, maybe ratios. So we have two methods. Always remember, method number one, they only have one account that is capital accounts. Capital. Only one accounts, capital. And method number two, they use this retained profit account, retained profit. So they have additional capital, retained profit. So for this 60,000, if the company make profit, they agree that B will get 42,000, C will get 18,000. So what is the process? If you are using a single account capital, I'm going to credit the capital for backer and credit the capital for cook. So sorry, 42,000, 18,000, 42,000, 18,000. This will go to backer and capitals, and we're going to close our P&L distribution. So this is method number one, that is single capital accounts. Single capital account, or only capital accounts. Only capital accounts. For method number two, we're not going to touch our capital, so no change in our capital here. No change in our capital, but we're going to create a new account, call it as a retained profit or retained earnings. So this go to the retained profit for backer, this go to the retained profit or retained earnings for cook. So we're not changing the capital account. We leave it like that. Yeah. So this is the method number two. So if you're looking at the method number one, for example, in this example, the capital, we only have capital account 192 and 118. Only one accounts, capitals. If you're using method 2, we split the capital. We will not change the capital accounts. The capital, original capital is 150 and 100. And the retained profit will have separate account, retained profit for Becker and retained profit for Cook. So the total is still the same. The total is the same, but the way you present is different. The way you present it is different.